Well, now, last year, East Africa's biggest economy only managed to create 57,900 new jobs in the formal economy. Lending has slowed down to multi-year lows of barely over 4% per year in February, and inflation has skyrocketed to well over 11%. Given this gloomy data, can East Africa's biggest economy grow by 5.5% this year, as the World Bank had forecast? That is a question that Ramanyang put to Standard Chartered's Razia Khan.
Interesting data points coming through from the East African economy. Private sector credit growth essentially on a declining trend for the last 14, 18 months. Job creation in 2016 at a level we haven't seen in years. And on top of that, there's an election coming up in the month of August. What's your outlook for the Kenyan economy this year?
Standard Chartered has long had a more benign view of prospects relative to the consensus out there. So even though we recognise that growth was at a robust level last year, that creates a higher base of which to measure growth. This is problematic. The slowdown in credit is very real, and it preceded the legislation. This is a slow burn that has been underway for some time and will not be adding to economic momentum. When you factor in election-related uncertainty, no matter how good we see or how favourably we see the passage of elections, the fact is there is uncertainty around those dates. This is likely to be a prolonged period of uncertainty that will help to weaken the economy further. And then there is the regional drought to contend with. All of these factors at the same time, when you've measured growth off a very high base, suggests that something like 4.5% growth wouldn't be unheard of.
Yikes. Okay, that's a pretty small number, at least in the Kenyan context. But what about inflation? 11.4% is what, a 57-month high for Kenyan CPI. And the bulk of it is really just coming through on food. But as you told me a little earlier when those numbers came out, as far as you're concerned, you don't see a case for tightening by the central bank.
If you look very carefully at the inflation data, you will see that the effect is really very pronounced on food and food only. We've seen some uplift in month-on-month acceleration in the hotels, tourism and restaurant sector, which may in itself be related to food inflation. Across every other single category of inflation, we are seeing very benign month-on-month trends or deceleration in prices. This means that demand is already sufficiently weak to suggest that there's very limited likely effects of a secondary impact. We're not going to see people in Kenya putting up prices the way they would have with previous food price inflation experiences for this very reason. Demand is weak, maybe retailers don't feel that they can push prices up. What could change? The recent announcement of a minimum wage increase. Up until now, there has been no evidence of any secondary price pressures in Kenya, but if you throw into the mix rising incomes at a time of these inflationary pressures coming from food-related sources, then that might alter the outlook.